Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from the city of brotherly love, where it's rainy and cloudy, I bet today, Dimitri Pargamonic. Is it
Good
raining and
morning,
cloudy?
Will. It is rainy and cloudy. Well,
It
right
is.
now, mostly cloudy. Maybe a little bit of drizzle.
Yeah, it's rainy here in Bucks County. You want to start with a disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Awesome.
So I'm going to share my screen. If you guys are joining us for the first time, just so you know, the reason we do this show is to answer any questions you have about Market Chameleon tools, data, analytics, strategies. You want to bring up something unusual or something you've seen that you want to share with the community. You can put the question on the live chat on YouTube. If you want to come on a show and ask your question live, direct, sometimes it's better to verbally express the question. We also put out a link to Zoom. Click on that link. It takes you over to Zoom. Once you're inside Zoom, click on raise your hand. You don't have to turn on your video camera, but once we let you in, everybody could hear you. You could ask your question live and direct. Those are the two ways to ask questions. While we're waiting for questions to come in, we'll start out with the pre-market report. This way we'll allow some questions to give it some time for questions to come in. If we don't have questions, after that, I'll go to a couple of reports, give some insights. Maybe we'll take a look at the earnings report, see some insights on earnings moves. If we do have questions, will stop me, let me know what they are, and we'll answer. We'll take the questions first.
All right, perfect.
So pre-market report. These are stocks trading in a pre-market hours. We have a list of our most active stocks, biggest percentage gainers, biggest percentage decliners. Coming down here, I see 48 stocks made our percentage gainers list, 153 on the decliners. From this perspective, right now we're setting up for a more bearish bias at the open. I'm going to filter down this list because right now, as you can see, a lot of stocks in this list are low cap stocks. They could be ETFs, leveraged products, closed-end funds, anything that trades on the major US exchanges can make this list if it meets our thresholds with volume, percentage move, and all that. Let's narrow down this list. And what I'll do is, as an example, we'll take it down to S&P 500 companies. You could also narrow it down to your watch list or any kind of a group, that you try to create in your own watch list. But let's narrow it down to S&P 500 companies, see what's going on there. To do that, we could use this filter here in ETF. We're going to drop it down. We see a list of ETFs. And when you select one of these ETFs, the list below will get filtered by stocks that are holdings in that ETF. SPY, that's S&P 500 ETF, select that. And when you select it, the data table below will get filtered by stocks that are holdings in that ETF. SPY is S&P 500 ETF, and you can see here, 0 met our threshold to make the percentage gainers. There are 39 that made our percentage decliners list. So right now, from this perspective, we're looking like we're setting up for a more bearish bias at the open. And of course, we had some pretty decent rallies so far this month. Some of it has to do with China reopening. China's stock market definitely had a big rally. Then there are some signs that inflation at least moving in the right direction. It's not low. It's still pretty far away from the Fed's target of 2% annually. I think we're still way
Six
up
and a
there.
half.
6.5%. Still far, far away from that 2%. And we don't know how long it will take to get down to that 2% and what else the Fed will have to do to get it down there. And something to keep in mind that the Fed stated that not only is 2% their target rate, but they want to see that sustained for a long period of time before they start easing. And even if we're moving in the right direction, that doesn't mean that the Fed's going to start lowering rates, because they've indicated they're not going to be lowering rates for a long time. I think they said even through 2024, so far, they don't see a reason why they would be going lower on the rates. And if they're not lowering rates, and if they keep the rates where they are, and I think right now the indication is 5% peak rate, they consider that in a restrictive territory, meaning that those rates are high enough that it's actually doing the opposite of stimulating the economy, right? It's contracting, it's being restrictive, meaning that it's higher than they want it to be in the longer term. So those are still things to consider, that the market a little bit is fighting the Fed. I think we're talking, where we see the markets get excited, they start rallying, people think, okay, we're now heading back into the bull market. And almost every time we do see a Fed official coming in and saying, whoa, you guys are getting ahead of yourself. We have no plans to lower rates. And that right now, I feel like that's kind of a seesaw. What do you think, Will?
Yeah, no, it's 100%, 100%. It's a total, I mean, people are totally fighting the Fed. And, listen,
10-year Treasury is fighting the Fed. The dollar weakness is fighting the Fed right now. And those things make the job of the Fed harder, right? If all of a sudden they're seeing 10-year treasuries falling, dollar weakening, people bidding up asset prices, those are working contrary to what the Fed is trying to do right now. If there are no questions, Will, what I'll do is, we have been getting some reports coming out, earnings reports. We'll take a look at a report and get some insights. What's going on with stock prices after they report earnings?
All right, we do. I think it's important because it is the start of earnings season. We do have some questions. I can tell them to you now, and you can go into them if you want, or
sure.
We can
Let's
go
do
after.
that.
All right. Well, Area as is asking, if you wouldn't mind, I am curious about vol skew reliability and predicting turns or moves in an underlying security. I mean, that sounds like a whole show.
Yep.
And Orange Jealous asks, hey guys, in order sentiment, trader size, does professional represent market makers only? He's actually a new user, just came on, or a new member of the chat just came on today. So I don't know if you want to answer that one first, because it seems like it's a pretty direct question.
Yeah. So two very good questions, actually, and thank you for the questions. One of them, let me kind of go to the first one was skew, right? The first one was skew and the direction, predicting the direction of the market. Okay.
Well, it could be the market or an underlying security, right?
Or underlying security. So trying to predict the direction of the underlying security. And that's not what skew is. It's not a predictor of what the market, like a volatility is a predictor of the volatility of the market. Skew is an observation of how the upside calls are being priced versus the downside puts. Okay, so it's an observation at this moment in time. So it's, we sometimes people can use it as some indicator of a sentiment, just like, look, the interest rate curve, right? When we look at the interest rate curve, the Fed funds rate is, at one interest rate, like right now, 4%, the 10-year bond is at 3.5%. And some people say, well, that's an indicator of a recession. And maybe, but it could be telling you something else, but it's an observation between two securities, two assets that have similar things in common, and there's a relationship between them, and what are the relative values, because they can't get completely out of whack, so there's some relationship with them, and how much are they diverging from their historical. Okay, so skew is not a direction, but it's a comparing of two options on the board. Okay, let's come out here. I'll come out a little bit further. It's easier. It's comparing two options, right? Like, let's say here's the at the money, and it's comparing an upside call, let's say up here, right, to the downside put, and saying, well, how expensive is this call on a relative basis to this put? So I'll give you an example. Let's say that, if I go up 5%, and if it costs me, let's say $2 to buy a call, and if I go down 5% and costs me $4 to buy the put, well, that means the put is 2 times more expensive than the call. So I could sell the put and buy 2 calls, right? And that moves around. Okay, so that moves around based on supply and demand at the time, right? So if there's a lot of demand for puts, that could start moving higher, or if there's a lot of sellers of calls, that could start moving lower while the put remains the same. And so that skew flaps around. And it's a measurement of the relationship between two like assets. So think of it as if I was comparing, the prices of new construction versus, existing homes, and there's a gap there. It's not really predicting the direction of the real estate market. It's just it's an indicator of how far apart they are. So if new home prices are moving, at a higher premium than existing homes, it could be an indicator that there's just more demand for new construction, or the new construction, it's becoming more expensive to build new homes relative to was before. So those premiums are going up, but it's an indicator of, bullish calls versus bearish puts and what people are doing. And if people are trying to hedge downside risk, protect themselves, those puts could go up. But we don't know what will happen tomorrow or whatever. That's just what's happening right now. You're observing the behavior and the markets and what they're doing at the moment relative to how they've measured up against each other in the past. Hopefully that makes sense. So let's take a look at an example of a benchmark skew. There are different ways to measure skew. Okay, one is, you could do by deltas, you could do percentage away, you could do by implied volatilities, you could do by premiums. And here, this is looking at a risk reversal. So risk reversal is a measure of skew as well. And in this situation, we're looking at a 5% out of the money call versus a 5% out of the money put that has 30 days left to expiration. And if the call price gets more expensive, so if we're buying the call and selling the put, right? If that's the case, then this line over here. This measures the difference. This line will start going up because the call price relative to the put price is going up. If the puts are getting more expensive relative to the calls, this line is going down. All right. And what this is indicating is that the skew here is moving in a more bullish direction, meaning that the markets are betting more bullish than usual, right? Doesn't mean it's going to go up, but some people use it as a contrary indicator, just like the VIX, right? So think of the VIX. When the VIX is very high, well, what is happening? It's very high because it's maximum fear. When the VIX is very low, think of it as why is the VIX very low? Well, people right now at the moment, they don't have anything to fear, so they're betting at with less risk premium built into the market. Okay, they demand less premium for the risk. So it's not an indicator of the future. It's how people are right now, and if it's moving to one extreme or the other. Okay. So and by it's kind of like a spread, right? It could be when you're buying one, selling the other, you can do a call spread, put spread, or a risk reversal, because you are comparing two different basically strikes around the at the monies. Let me show you let me see if I could display it let me do it here.
Well, it's interesting. There's a TikTok going around. I don't know if I shared it with you. It's a scene from Billions, and a trader is trying to get out of some stock and talking about how, the lead character wants him to get out of, a couple millions of shares of the stock, and he's planning on placing over 4 different brokers to try to hide the trade. And a young junior analyst over his shoulder is telling him that he should just do the opposites, or buy the puts and sell those upside calls to try to hedge his position and slowly get out of the stock trade. That was her call. And they do the analysis, and it saves them a significant amount of dollars.
That's what you're doing, because you're scanning the markets to see where, if I have an agenda and if I'm trying to do something, where is the best place of liquidity and the cheapest way of accomplishing that goal. Here, let me show you that. So this
actually,
is
Michael McCrae was asking something about the skew levels. Let me just get to it. He says, what skew levels would indicate bullish or bearish sentiment?
Right. So right here, this is the implied volatility skew based on 25 delta. So this is a different way of looking at it. And what there are different reasons for looking at it at different ways. I don't have time right now to explain each way, but this one is looking at the implied volatility differences between the 25 delta put, 25 delta call. So it's not a percentage away. It's based on delta, which is normalized to at the money implied volatility. Okay, so if you want to normalize it to at the money implied volatility, you could use the delta skew. All right, the other one was normalized by percentage away. So you could see here that the skew keeps falling to a more bullish level. Look from here, because here you see bullish, more bullish, because if you're 25 delta put minus the call, meaning that if the put is getting cheaper relative to the call, the implied volatility, this is going down. If it's going up, it means more bearish. And I'm going to overlay that with the at the money IV. And you could see here, the spread between the two keeps widening. So the skew here, what it's telling us is that is falling much faster than just the implied volatility. So the implied volatility could fall because there's more complacency. It's getting cheaper to hedge. But you could see here that the skew is accelerating faster, meaning that those wings are just not in demand right now as they are. So the wings are falling much faster than the at the monies, according to this, indicating that the markets right now are not fearful of tail risk. Okay, that's kind of the indicator here. That doesn't mean it's going to go up. That's just how the markets are lining up. And what do people will look at it as? First, is the market too complacent, or is this an opportunity where it's gotten so cheap? Maybe if I need to hedge, then the time to hedge is now, because it could get more expensive. So those are different ways to start looking at it. I think that as traders, as you trade more and you become, grow a trading operation, grow your portfolio and stuff, you stop thinking by direction, that I have to be right in the direction of up or down. Like, that starts to go away, and you start thinking of it from different perspectives of how asset prices are priced versus each other. You start thinking about borrowing costs, lending costs, the expected returns, positive EVs, stuff like that. The thought process of being right in direction, up or down, and exclusively that, to be right on direction, I have to make a call. If the thing's going to go up tomorrow, go down tomorrow, that's the very beginner stage. Okay, that's like that's how everybody enters the market. In the thought process, I got to be right in calling the market going up or coming down. And if you're going to last for a long time, you're going to start moving away from that and start comparing asset prices and things that are undervalued, overvalued. Is the spread is there a big divergence in something? Did it go too far away? And why? How do I hedge things? How do I extract implied volatility versus realized? How do I extract the differences between my borrowing costs and lending, and where do I find high expected expected value? Where my probabilities in my favor? Like, start thinking that way. And you should start thinking that way as you progress. Okay. So what is this telling us? Don't think of it as direction. Start thinking about it as, wait a minute, there are two things here, price versus each other, and they're starting to diverge from historical levels, right? What's going on here? Why are they doing it? How can I hedge it off? How's SPY skew compared to QQQ skew? How is the SPY skew really cheap versus selling it in IWM? Are they correlated? Have they diverged to enough that it's a tradable? It could be a tradable opportunity. So that's kind of why we're studying the markets from that perspective. Any questions? Does that make sense?
That's very helpful to you. Everyone is
try to move you guys in that direction, slowly.
That's very thankful for the answer. That was very thorough.
Yep. So what was I on before? Was there another question? Sorry, there was another question besides skew, wasn't there? I think there was a second.
Let me grab it. The other question was from, I put out the link to the TikTok for anyone who wanted to see it as well.
Yeah, there was a question. It wasn't after skew. You asked me two questions.
Yeah. Aria says, thanks guys. Even when the skew is not indicative of the market sentiment, I love this time series plot of skew. It gives me a better point estimate. He said,
awesome.
Bob said trading volume in the VIX has become thin as well.
Yeah.
Oh,
Think right after-
it was from a new user, Orange Ellis.
Order sentiments.
Yeah, order sentiment
Order
trade size. Does professional represent market makers only? Thanks.
So yes, so when we go to the order sentiment here, let me see. So this is an SPY from yesterday. Okay, so this is yesterday's SPY. We're not open yet today. And besides, we try to break down in essence what we believe interpret is going on in the options markets, versus deltas, and we also break it down by the order, the trader cohort. Okay, like what type of trades are coming in there, and from what kind of trader is participating in the markets. So over here, you could see here we do it by trader size type, and this isn't the size itself, the size of the trade. It could be with the market maker, could have been crossed. That's not what this is isolating. It's isolating how much of the volume, this one over here is looking at just single leg calls and puts, how much of the volume that we're using up here to create the sentiment, right? How much of it was from large institutional size trades? So the market maker, could be on the other side of that. Goldman Sachs, Citadel, Susquehanna, they're already really large institutions on their own and they're market makers, but they could be on the other side of a different institution. If they're providing liquidity, then there's two sides, and could be one really big institution needs liquidity and they're going to act. And if they can't cross it with another institution, they might have to go to, like a Citadel, Goldman Sachs, or who else is that? Wolverine, Susquehanna, these big liquidity providers, and they might have to trade them. Jane Street, a lot of big liquidity providers out there that can take the other side of a big trade. But once that trade occurs, right, the trade occurs, we look at it and say, well, this trade was so big that it's not likely that it's a small retail investor or retail investor even, because it's just it's not likely it's coming from like a typical E-Trade account, because you don't see like, $2-3 million worth of options premiums coming from those accounts usually, So then we say this is more of an institutional size trades. And we have certain thresholds that we believe we set that based on either the notional value of the trade or the size of the trade, that it's probably coming from either an institution. Then we have thresholds that it's most likely a professional. So professional could be someone trades trades probably frequently and in higher size, because you need to, when you're trading options, when certain things you do, you need to get approved for, right? So you can't just open an option account and do whatever you want. You can't open an option account and sell, 500 puts in SPY. You'd have to get approved for that, or sell 500 puts in, a Coinbase. They won't let you do that. They're going to block it. So to have an account that allows you to do that, you have to be already like a professional account where you have lots of years of experience, enough money in your account, and that they trust you, to do that kind of an order. So we look at the orders and we look at either a block trade or a series of orders. So sometimes, there's an order that gets split up and we have to group it together. And then through our analysis, we say, okay, well, if this is one contract for $200 and there's nothing else trading around it, that's most likely a small retail trader, right? It could have crossed, with another small retail trader, or the other side could have been a broker dealer or whatever, but the end user entering in that order was most likely a small retail trader. Retail trader, we look at maybe higher size. It could be, 5, 10, up to, I think we go up to like 20,000, depending like what we think the order is. And then we go with professional, institutional. This is our interpretation of the order flow. It doesn't have to be, market maker to market maker. We're only looking at that the dollar value and size of the trade is what kind of trader type would be engaged in that type of a risk trade, and that's how we divided it up.
All right. Well, the market just went off about a minute ago. Great job, D. A couple housekeeping notes. No show on Monday. It is a holiday. No trading. I will be having a webinar with Dan Passarelli. It is earnings season. I'm sure on Tuesday we will talk more about earnings. Thanks for answering all the questions today, D. Great job.
Yep, guys. Thank you for the questions. This is really good questions. Really appreciate them.
Yeah, actually, Rob had a question at the end. I did copy that and send it to you, so we can maybe get to that on Tuesday as well.
Okay, yeah. So let's look at that next week. Everyone, stay safe out there. Have a great trading day. Enjoy your weekend. We hope to see you guys on Tuesday.